November 26, 2025 is expected to see Chancellor Rachel Reeves deliver yet another seismic autumn budget that is expected to introduce new tax measures targeting your salary, your wealth, your property, your pensions, and any gifts you give and receive. As government borrowing costs hover at a 27-year high, and with fiscal pressures estimated between 20 and 50 billion, these rumoured changes represent what could be the most radical overhaul of asset taxation in decades. In this video, we'll reveal the top 7 that are currently being discussed. Now, an important note, the following measures are based on media speculation, think tank reports, and industry analysis circulating ahead of the budget. They're not confirmed government policy. All figures and projections discussed are drawn from reputable industry speculation, media reports, and expert commentary in the run-up to the budget speech. One of the most shocking tax overhauls being discussed is a complete scrapping of stamp duty land tax, with it being replaced with an entirely new annual property tax system. This would represent a fundamental shift from one-time purchase tax to an ongoing ownership levy. Currently, stamp duty generates around £11.6 billion annually for the Treasury, with buyers paying tax rates ranging between 2 and 12% depending on the property value. And the system has been long criticised as a barrier to housing mobility, particularly affecting first-time buyers and those looking to downsize. Under one rumoured proposal, property values over £500,000 would face a levy between 0.3 and 0.6% per year on the value above that £500,000 threshold, with potentially even higher rates dependent on your house's value. Alternative proposals include allowing buyers to spread stamp duty payments across several years through regular instalments rather than a lump sum at purchase. City AM has reported that the staggered payment system is under active discussion at the Treasury, designed to boost the housing market by reducing the upfront cost for buyers. This shift would create clear winners and clear losers. Around 60% of home buyers currently pay stamp duty, but only 20% of properties would face the new annual tax. By shifting the tax burden from transaction to ownership, the reform aims to lower upfront costs for buyers and to improve market liquidity, whilst also ensuring that the wealthiest households contribute more to public finances. Under the current inheritance tax regime, individuals can make annual gifts up to £3,000 tax-free, and larger gifts become exempt if the donor survives for more than 7 years. In the autumn 2025 budget, the Treasury is expected to introduce a lifetime exemption cap on all gifts given during a person's lifetime. Once the cumulative limit is exceeded, any further gifts will immediately be subjected to the full 40% inheritance tax. This new cap will bring fundamental changes to estate planning. High net worth individuals who have relied on annual gifting or large lump sum transfers to children or trusts will now face an outright limit. For example, let's say the cap is set at £200,000. A £50,000 wedding gift to each of your 3 children would consume £150,000 of this, leaving you only a remaining £50,000 for all subsequent gifts over your lifetime. Any breach of the £200,000 threshold would trigger a 40% tax, meaning that a £10,000 birthday gift could cost you an additional £4,000 in tax. The cap's introduction is designed to curb wealthy families' ability to reduce their estates through gift chains and to also prevent complex structures circumventing taxation. According to the tax consultancy SW Group, the proposed limit is aimed at raising an estimated £3 billion annually by 2028, whilst also simplifying inheritance tax frameworks. As we've just touched on, currently gifts become exempt from inheritance tax if the donor survives for 7 years, with tapered relief reducing tax liability for gifts made between 3 and 7 years before death. There are multiple credible sources reporting speculation around extending this period further. SW Group states that the discussion is currently focusing on 2 possibilities. First is to remove the 7-year rule, or secondly, it's perhaps to extend the period further up to 10 years. If implemented, this could mean some of the following. First, gifts made between 0 and 10 years before death potentially could face the full 40% inheritance tax. Secondly, the possible removal of all tapered relief reductions. And finally, a uniform 10-year window replacing the current 7-year rule. Capital gains tax, also known as CGT, historically offers lower rates than income tax. Speculation does currently exist around potentially aligning CGT rates fully with income tax rates. The IFS has previously discussed and presented reform options, but there's no confirmed alignment rates officially being proposed as of yet. The rationale behind this alignment is to eliminate the perceived anomalies between earned income and gains on assets. Any such alignment would represent a significant increase from current rates, but the exact impact remains unknown without confirmed policy details. Pension tax relief currently varies by income band. Basic rate taxpayers receive 20% relief, higher rate taxpayers receive 40%, and the additional rate taxpayers receive 45%. But it's one of the most richest forms of tax breaks at a cost of £48 billion per year to the Exchequer. The autumn budget is expected to replace this tiered system with a flat 30% relief rate on all pension contributions, irrespective of the taxpayer's marginal band. Under the proposed relief, all contributions get a 30% relief at source, with higher and additional rate taxpayers losing up to 15 percentage points of their previous relief, whilst basic rate taxpayers gain an additional 10%. The Treasury anticipates that this change will save around £6 billion annually by 2028, while simplification may also boost pension participation among lower earners. Currently, there's something called the Principal Private Residence Relief in the UK, and this means that you don't have to pay CGT gains on your primary residence, no matter the property value. The autumn budget is widely reported to remove this exemption from homes valued above 1.5 million, meaning that any gain over that cap is now subject to any newly announced CGT rates. Under the new rules, we could see potentially property sale values above £1.5 million being subjected to the full CGT rate for that entire gain. This measure could raise about £1 billion per annum and bring parity between owner-occupied homes and investment properties, according to analysis by the Tax Journal. Income tax, personal allowances and bans are already frozen until April 2028. The autumn budget is expected to potentially extend this further by 3 more years, up to April 2031, despite rising wages and headline inflation. This stealth tax or fiscal drag pushes more taxpayers into higher bands without changing rates. An estimated 1.5 million additional taxpayers could be drawn into higher rate tax bands by 2029, with an expected revenue gain of £8 billion by 2029. The Institute for Government has warned that these frozen thresholds will disproportionately affect middle earners, even as the government maintains that it's not raising headline rates. In my opinion, this could be a very painful change for a lot of people in the UK. Please remember that these remain rumours and speculation for now. Only measures confirmed in the actual budget on November 26, 2025 should guide your major financial decisions. The speculation may either prove entirely wrong, partially accurate, or completely different measures may be announced. Given the speculative nature of these measures, but also the impact they might have on you, please consider consulting a qualified advisor about current tax planning opportunities in preparation for any potential changes. Hopefully, this analysis has helped you to understand what might be coming and how you can potentially prepare. Please share this video with your friends and family to make them aware of the speculation, but also emphasize that these are unconfirmed rumours and not definite policy for now. If you found this analysis helpful and you've liked it, the YouTube gods and the algorithm suggest that you might like this video even more. Until next time, ta-ra.